Everyone's asking, should I buy bank stocks now? Are they cheap? But that is the wrong question. The question is, do you have a framework to evaluate banking sector opportunities yourself? Do you know how to read the ROA tree to understand which banks and NBFCs are performing well? Can you identify when to enter and exit based on valuations? Today, I'm going to give you that framework. And I'll share my proprietary ETF selection framework too. By the end of this video, you will know exactly how to evaluate whether banking sector investments make sense for your portfolio. Also, do subscribe to the channel to not miss upcoming sector deep dives in this series. So let's begin. Most people buy banks when everyone is excited and they panic during corrections, then wonder why they lose money in a sector that has been compounding for decades. We are going to fix that. And to be clear upfront, I'll walk you through specific examples and ETFs, but not as investment recommendations. I am going to show you how to analyze any sector using banks as the case study. Okay. Thematic investing needs three things. One is deep knowledge about how the sector works. Two is understanding the right valuation metrics to time entry and exits. Three is emotional discipline to buy when everyone is pessimistic and hold till the theme plays out. Let's start with building knowledge about how the sector really works. The financial sector has two broad categories. First are banks. These include large private banks like HDFC Bank, ICICI, mid-sized private sector banks like Indices, Federal, IDFC, public sector banks like SBI and Bank of Baroda, and small finance banks like AU Small Finance Bank, Equitas, Ujjivan. Second are non-banking financial companies. These specialize in niches like housing finance companies like LIC, Aavas, Aadhar, vehicle finance companies like Shriram Finance, Sundaram, gold loan companies like Muthoot, Manappuram, microfinance institutions like Credit Access and Arman. There are other multi-product NBFCs such as Bajaj Finance and Aditya Birla Capital. Let us understand the unit economics of banks by understanding the ROA tree of HDFC Bank and of NBFCs by understanding the ROA tree of Bajaj Finance. An ROA tree simply breaks down how every rupee of a bank's income and cost flows into its final profitability. Let's understand this by looking at the latest Q2 FY26 results of HDFC Bank and Bajaj Finance. First, starting with the cost of raising money. HDFC Bank raises money through deposits at around 4.5%. They lend to its customers at 8%. Hence, HDFC Bank's spread is around 3.5%. Add fee income to this and their total income comes to 5%. Let's look at NBFCs now by understanding Bajaj Finance's example in detail. It raises money from other banks or through corporate bonds from the public, and their cost of raising money is higher at 5.7% because they don't have access to customer deposits like banks. But they lend in their specific niches at 14.4%. Their spread is a whopping 8.7%. Add fee income and their total income comes to around 10.6%. That's more than double of HDFC Bank's total income. But let's look at the complete ROA tree to understand which one makes more for every 100 rupees lent. Coming to costs of both HDFC Bank and Bajaj Finance. HDFC Bank spends around 1.8% as operating expense, which includes employees' cost, office rent and branch expenses. While Bajaj Finance spends double as operating expenses at 3.5%. Banks also create lower provisions for loan losses because they lend to lower risk customers. So HDFC's provision cost is around 0.3%. On the other hand, NBFCs lend to riskier customers. That is why Bajaj Finance's provision cost is around 1.8%. Lastly, we deduct taxes of 0.6% in case of HDFC and 1.3% in case of Bajaj Finance to get profit after tax. HDFC Bank's PAT comes to around 1.9% and Bajaj Finance's PAT comes to around 4%. That simply means if both lent out 100 rupees to their customers, HDFC Bank earned 1.9 rupees on it while Bajaj Finance earned 4 rupees on the same 100 rupees lent. Now, here is the interesting part. Banks and NBFCs do not put the entire 100 rupees of loans from their own pocket. In case of HDFC Bank, if it lent out 100 rupees, then only 13 rupees is its own equity, and they raise the remaining 87 rupees through liabilities from deposits or bonds. That creates a leverage of 7.7x because they are lending 100 rupees on just 13 rupees of their own money. That makes banking a highly leveraged business because banks will earn interest income on this borrowed capital of 87 rupees also. Because of this leverage, a bank that earns 2 rupees on 100 rupees of assets can still deliver 14 to 15% return on equity because it made 2 rupees on its own equity of 13 rupees. In formula terms, ROE is directly proportionate to ROA and leverage. The higher the leverage, the higher the ROE, but even the risk will be higher. Even for Bajaj Finance, for every rupees 100 lent to customers, it puts only 20 rupees of its own money. The rest 80 rupees is borrowed from banks or through corporate bonds. Hence, Bajaj Finance is levered by 5 times. That means it made 4 rupees on total assets of 100 rupees, but on its own equity of 20 rupees, Bajaj Finance made 20% return on equity. Now that we have seen the complete ROA tree for the top bank and top NBFC, let's look at what levers both have to improve their ROA and ROE. Lever 1 is net interest margin. Banks can either increase lending rates or reduce deposit rates to increase the spread. Lever 2 is fee income. Higher the fee income, the better because it's not capital intensive. Lever 3 is credit costs, which means bad loans as a percentage of the loan book. Lower the bad loans, the stronger the bank. Lever 4 is to manage operational costs more efficiently. Good banks maintain high ROA, high ROE consistently along with earnings growth, while substandard or average banks have terrible credit costs, inconsistent ROA, ROEs, and slow earnings growth or degrowth. This was the first requisite, which is sector knowledge. Now we need to understand the other 2 important requirements for sector investing. Second is to know the valuation of the sectors in which you want to invest, because even great sectors can be terrible investments if bought at the wrong price. For valuation in financial services sector, we'll look at price to book metrics and not price to earnings, because banks don't manufacture anything. They simply take liabilities in the form of deposits or bonds and give out loans which are their assets. So the book value, which is essentially assets minus liabilities, is literally the size of their lending engine. A bank grows only if it grows its loan book, which increases its book value over time. So valuing it on price to book directly ties price to its core engine. On the other hand, reported earnings used for price to earnings ratio can be more volatile and look artificially low or high depending on where we are in the provisioning or rate cycle. For most fee-based or asset-light financials like AMCs, brokers, fintechs, wealth advisors, PE matter more than price to book, as they don't essentially have a loan book as their core engine. Price to book valuations are a derivative of 2 important factors. First is consistently high ROE, and second is consistently high earnings growth. But ROE and growth must be adjusted for asset quality and risk. A bank can show high ROE for a while by under provisioning or taking excess credit risk, which should not deserve a high price to book. So essentially, you need to check for credit risk. Now, let us see the 4 major indices that track the financial sector companies. And more importantly, let's look at the valuation of these indices. Nifty Bank tracks 12 large and most liquid public and private sector banking stocks, and it is the benchmark bank index in India. It is currently at a price to book of 2.2x, while its historical average is 2.6x. So, as per historical valuations, there seems to be room for valuation expansion if fundamentals stay strong. Nifty PSU Bank tracks all 12 PSU banks in India. It includes banks like SBI, Bank of Baroda, and PNB. It is currently at a price to book of 1.4x when its historical average is 1x. This means that PSU valuations have moved up sharply and the index does not seem cheap anymore as per historical valuations. Nifty Private Bank tracks around 10 to 12 large and liquid private sector banks out of total 21 private sector banks in India. It is currently at a price to book of 2.2x when its historical average is 2.9x. So based on historical valuations, there seems to be headroom for valuation expansion here as well. Nifty Financial Services X Bank tracks 30 financial service companies other than banks, focusing on NBFCs, insurance, and exchanges. It is currently at a price to book of 4.5x when its historical average is 4x. Now, a critical point about these valuations. I am comparing current valuations to historical averages. But historical averages doesn't automatically mean fair value. It just shows us where the market has priced these sectors before. If fundamentals have structurally changed, the historical average might become misleading. For example, PSU banks traded at 0.5 to 1x price to book historically because they had 12 to 15% gross NPAs and terrible governance. Today, gross NPAs are down to 3 to 4% and recovery mechanisms have improved. So, should PSU banks still trade at historical averages or should they be structurally re-rated? Some investors believe PSU banks now deserve valuations closer to private banks of 1.5 to 2x book instead of 0.5 to 1x. I am not taking that position here. I am just showing you the framework that needs us to understand the finer nuances in valuations. You'll need deep sector expertise and conviction to take a judgment call on structural re-ratings in such circumstances. We as investors need to understand why the historical averages of price to earnings and price to book was what it was and whether those reasons would apply even in the future. Third is emotional discipline to buy when everyone's pessimistic and ride through the volatility till the theme plays out. Let's develop a framework by looking at historical valuations. Here's what the data shows. Banking sector returns are highly cyclical. From 2014 to 2017, Nifty Bank gave 13% CAGR. From 2017 to 2022, it gave just 4% CAGR. Then from 2022 to 2025, it gave 15.5% CAGR. Same sector, but wildly different outcomes based on when you invested. That's exactly why you need to enter at low valuations and exit when the valuations peak. Let's look at another example through PSU banks. Suppose you got the timing right in early 2021 when PSU banks were hated. They had high non-performing assets, governance concerns, and everyone was avoiding them. For context, SBI was at a price to book of 0.9x when its historical average is 1.4x. BOB was at a price to book of 0.5x when its historical average is 0.8x. If you understood that NPAs would normalize moving forward and these banks were trading below book value, you could have invested in a PSU Bank ETF in 2021. By 2024, that investment would have given you 2x return. But suppose you missed the 2021 opportunity. By now, everyone's talking about PSU banks. You feel FOMO. You invest 10 lakhs in a PSU Bank ETF in 2024. What happens next? Maybe some more upside of 1.3x. But the easy 2x is done now. You are now entering at elevated valuations. Do you see the problem? Thematic investing works only if you can identify themes early when they are unloved. Stay invested through volatility and exit when valuations peak. Now that we understand why valuations matter, let me show you how to pick the right ETF for your chosen index. Let's say, based on your analysis, you decide private banks are worth studying right now because you find out that the valuations are less than historical average and outlook on earnings growth and ROE is strong. Then you can consider applying my proprietary REAL ETF framework to identify the right ETF. REAL stands for R is for returns across 1, 3, 5 and 7 years. E is for expense ratio, which should be low. A is for AUM or fund size, which should be high. L is for liquidity, which means how high is the trading volume of these ETFs. ETF stands for E for efficiency, which means lower premium to the actual value of the asset. Tracking error is how closely the ETF is tracking the underlying asset. This should also be low. Fund composition is, of course, which index is the ETF tracking and which stocks does that basket hold. But in case of sector investing, it is also important to look at valuation. Hence, just for sector investing, I'll also add V for valuations in my proprietary framework. Valuations basically mean where are the price to earnings and price to book in case of bank, and if there is a possibility of a future re-rate. To demonstrate the application of the framework, I'll take Nifty Bank as an example. First and most important for sector investing, as discussed, is valuation. We saw that Nifty Bank is currently trading at a price to book of 2.2x, which is below its historical long-term average of 2.6x. Let's apply the REAL ETF framework on Bank Bs by Nippon to understand it in detail. This is the oldest bank ETF, started in 2004. Bank Bs have made good returns in the last 1, 3, 5 and 7 years. Expense ratio is low at 0.19%. AUM is 7,800 crores plus, which is sizable. Liquidity is also high at 6 lakh units traded per day. Efficiency meaning premium to INAV. Premium means you are overpaying against the actual value of the asset. This premium is usually created when the ETF's demand is higher than its supply. For Bank Bs, premium is at 0.09%, which is on the higher side. Tracking error is also low at 0.03%. Fund composition is of 12 large and most liquid public and private sector banking stocks. That is how you apply the REAL ETF framework to other ETFs also. The other 3 ETFs tracking Nifty Bank ETFs are Bank I ETF by ICICI, ABSL BAN ETF by Aditya Birla, and HDFC NIF BAN by HDFC. You can also use this framework on other sectors you wish to invest in after understanding the sector in detail, knowing the valuations, and having the emotional discipline to enter at low valuations and exit at high valuations. Most passive investors don't have the time or sector knowledge to be able to meet these 3 important requirements. This is exactly why in my January 18th webinar, I am teaching goal-based investing that doesn't require timing sectors. It will be a live webinar on Master Your Money with Goal-Based Investing, where we will dive deep into how to plan SIPs for long-term goals like retirement, children's education, and financial freedom. Second, how to calculate the right investment amount by factoring in inflation and taxes so you never fall short of your goals. Third, how to build an investing approach that helps you feel stress-free, secure, and confident about your financial future. This will be a practical and action-packed 2-hour session where I will share my goal planning calculator sheet and we will work on it together live so you leave with a clear and personalized roadmap. The feedback from my previous webinar was amazing and many attendees said that they are looking forward and excited to join the next one, which makes me even more thrilled to do this session with you. Please note that this is a paid webinar. The registration link is in the pinned comments. Do check get that out. Okay, so knowing where we are in the overall cycle is extremely critical to your sector investing decision making. Please do your own research to understand valuations and timing of the sector before making any investment decision. This video is only for educational purposes. None of the sectors or ETFs are investment advice. To conclude, here is the big takeaway. Do not buy banks because someone says they are cheap. Buy them when you understand the business model, the valuations, and you know where we are in the cycle. Remember, even with the right framework, sector specific bets should be only 10 to 15% of your portfolio, not your entire equity allocation. Here's how you'll know this video worked for you. Can you now look at any banking stock and ask what's their ROA, what's their leverage, where's their price to book versus historical valuations, instead of just asking, is this sector or bank cheap? Can you resist the FOMO when PSU banks are up 50% and check valuations first? If yes, you've got the framework. Do share this framework with a fellow investor who needs it, and do subscribe to the channel because I'm doing more sector deep dives in the upcoming videos in this series. Thank you for watching. See you in the next one.